Hey team, welcome in. This is a quick global macro update, but today I'm going to focus on the macro situation with a key focus on interest rates, deficits, money printing, debt ceilings, all that type of stuff because of some of the releases that were going around last week, causing a lot of people a lot of consternation and alarm. So one of the things we're going to look at during this today's story is today's macro update. Again, we'll look at government data, deficits, spending, and either I am crazy or the government is delirious. One or the other. Please make your decision after you see this video. So the first piece in the box is the U.S. Treasury Department expects to begin taking extraordinary measures to continue paying government obligations before what is expected to be a big fight to raise the borrowing caps. And Janet Yellen urges Congress to act promptly to protect the full faith and credit of the United States. And if they don't, failure to meet government's obligations could cause irreparable harm to the U.S. economy, the livelihoods of all Americans, and global financial stability. Well, that's a bit of a mouthful, a little heavy on a Saturday morning especially. So let's look at the debt ceiling, what it looks like. Can anybody see a pattern here? So the yellow under Trump looks like it went to 31.38, under Biden 31.4, and that is trillions of dollars. It's insane, but you can see the acceleration of those steps up and up and up. And why is the debt going up? Because the Fed is saying they're going to reduce their balance sheet and stop spending and slow down the money supply growth, etc. So what exactly is going on? First of all, you look at what this is from Lyceon. This is the U.S. federal budget in 2023. Big thank you to Sanjay for sharing. If you look on the left, you see all the spending. You got your interest costs, which are going to explode, by the way. We'll talk about that in a minute. You got your non-defense discretionary, your defense, which is a huge chunk unto itself. Those two combined make up about $750 billion. Social Security, another big chunk. Medicare, Medicaid, another big chunk. And a ton of this is unfunded for the future as well. Then on the right, you've got that green box, income. I think that's going to be a fraction because a huge portion of tax receipts are made up of capital gains, and there were none in 2022. So those tax receipts are going to be horrible. Corporate, tiny sliver. Look at the corporate compared to what personal people have to pay in income taxes. Social insurance, other. And then borrowing, that's kind of the net gap of just shy of $1 trillion. My estimate is 1.5 to 2 trillion will be the deficit for 2023. Mark those numbers. Most probably closer to 2 trillion because that chunk of income is gone in 2022 because there's no capital gains. So let's look at the CBO's US budget deficit forecast going out to the future, out to 2032. Any pattern here? Anybody? Well, it gets bigger and bigger and bigger every single year. The deficit should hit $16 trillion in 2032. That is just 10 years from now. Again, I believe the deficit in 2023 will be 1.5 to 2 trillion. And it just accelerates. We're in the house of debt. But the real damage is caused by this. This is the interest cost exploding. That's the gray line on the chart here. It's going up and to the right. And by 2052, it could be as high as over 7%, probably closer to 8% of all U.S. annual expenses will be interest on debt. And then you got your Social Security in orange, your Medicare in gray, and then the yellow Medicaid and other subsidies kind of flat, which surprises me. I think that'll go up too. Again, lots of welfare programs that only begin to grow a lot faster as we go forward. Let's look at the government expectations as well. More funny numbers, funny math. The Atlanta Fed GDP now expects real GDP estimate to be approximately 4%. And growth as well. They expect good positive growth in 2023. I just don't see that happening. Unless, of course, they're fudging the numbers. We'll see. Let's talk about the big elephant in the room is a huge chunk of debt is short-term in nature, kind of 2 years or less. If you look at this chart, you've got the amount of outstanding government debt of 0 to 1 year and 1 to 3 years. This 50% is going to be rolling into higher rates real soon. And the weighted average maturity is about 6.5 years, and the weighted average coupon is 1.7%. But this stuff's going to be rolling off into 4.x% handles as they go forward, and that is also going to explode the deficit further to north of $1 trillion in interest expense every single year. Now, more funny math. This is an interesting one from Nick Timiraos. Hope I got that right. He said the Fed sent $76 billion in weekly remittances to the U.S. Treasury last year, but stopped doing so in September when higher rates led to its interest expense to exceed its interest income. It has then since booked an $18.8 billion IOU called a deferred asset. So the government is now IOU'ing itself. Again, kind of hiding debt in little buckets or pockets or little cups around the table, which is kind of interesting. I wonder when the piper will have to be paid. In addition, look at the bond market and more funny math news. And the bond market does not believe the Fed. You know, they think they're just jawboning. So this is the consensus expectations for the Fed funds rate, and it's down now just above 4.5%, which is kind of very close to where we are now. So lots of things are kind of changing. And the question is, what's going to happen? Is the Fed going to push us further into financial Armageddon, or hit the pause button and then cut based on some type of catastrophe? In addition, it's very clear that the Fed has struggled to reduce its balance sheet. These are the orange numbers of balance sheet reduction. They had very aggressive plans to reduce the balance sheet by $90 billion a month for the last 6 or 7 months, and they've only hit a fraction of that. I think about just under 200 billion versus what should be at least $500 billion. So they're way, way behind target. And to unroll things like mortgage-backed securities is extremely hard. And let's look at, it's not just the US government that's spending, but also the US personal savings rate is down near all-time lows at around 2%, which means everybody's spending everything they have because of inflation. They have to. They can't afford to save. And that is dangerous, especially with high rates on credit cards. Delinquencies will be next, I'm afraid. I hope I'm wrong, but they probably will be. Let's talk about Europe for a second. You can see that the EU has a different inflation problem, and this can all be boiled down to a couple of things. First of all, the chart shows you the US GDP growth is higher than the Eurozone growth in green, and the 4% was the NGDP trend growth, kind of pre the COVID interruption, and that was the trend line that's painted there. But the Eurozone inflation is less about too much money and more about too few goods. Hence, the Eurozone inflation remains fundamentally different, and this is why the intensity of money tightening in the US may not be appropriate across the pond in Europe. But there is another distinction as well. A lot of wage growth in Europe is kind of capped through negotiated wage growth or labor cost index, and the Euro area wage growth has remained tempered under 4%. In line with pre-COVID levels, as American wage growth has been a lot higher, north of 5%. So there's kind of some of the structural differences between what's happening in Europe versus the EU. And if we talk about China, it's a whole different kettle of fish altogether. And let's finally talk about what's coming next, because we know what's coming next. But this is the fall in the value of the Nigerian Naira. You can see how it's tanked over the recent history going back to early 2022, and it's basically down around half of its value. This is the power of the central bank digital currency. Nobody wants it. That's why all Nigerians are flocking towards things like Bitcoin, because they don't want the spy coin that is the Naira in Nigeria. So with that, everybody, just a brief recap. People are concerned about the debt ceiling, what it all means. And I just want to share some numbers that are all publicly available to say that the whole thing is just going to increase as we go forward. And as they continue to shoot themselves in the foot, increasing interest rates on themselves, blowing up deficits, falsely estimating things like GDP numbers, calculating revenue receipts when there's going to be no capital gains collected in 2023. It's all rather messy. So with that, happy Saturday, everybody. Hope you like it, and I'll see you soon.